Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics on a beautiful Wednesday afternoon for a variety of reasons, most of which I am joined by Reggie Middleton of Veritaseum. Plus, Reggie's getting some exercise, getting away from the computer a little bit, and has a nice walk outside so we get to see some nature. And how would I describe Reggie? All that stuff that I remember growing up in grade school: speak up for what's right, be honest, study hard, be a good person to society, create things. Really what I think parents tell their children the definition of a role model is. Now, there's a lot of things going on out there, but Reggie has embodied that, in my opinion, especially doing great things and having people who don't like great things being done get in the way. And we'll leave that aside today. But Reggie, I sure admire everything that you have done and stand for, and can't thank you enough for making some time to join us here today.
Thank you very much. Those are very endearing words. I appreciate it.
Well, they're very words that are quite deserving and appropriate, in my opinion. And I will pull up Veritaseum.com, which is what Reggie has been working on ever since he left the banking industry. And perhaps we will come back to that in a little bit, although I know a lot of you are familiar with that. And we'll touch on that a little bit later. Although one of the things that really excited to dig into today, because Reggie, you could put this in your own words, but I believe you're not a silver bug. You're not like me and the other people who are watching the channel that, hey, do we get emotional about it? Or are we tied to it? Sure, that could be absolutely true, but your expertise, you were in the banking industry. Perhaps I know people are familiar with Bear Stearns. So just can you give a quick rundown of your background so people understand the expertise of which you're speaking with, and especially touch on how you saw Bear Stearns before it collapsed, which I feel is relevant to what we'll dig into in silver today.
Well, actually, I was in the financial industry officially as an employee for only 9 months out of college. So after that, I was a lone wolf. But I taught myself finance, macroeconomics, and primarily valuation from an investment perspective over several decades. And it served me well because I didn't work within the industry, so I didn't have the indoctrinated blinders that almost everybody in the industry has, and that you need by definition to succeed in the industry. So I looked at this and I didn't see a bunch of gray. I saw a tree. A lot of people see tree bark or see a particular color. So that served me very well because when opportunity arises, I get to see the opportunity from as an outsider looking in versus an insider looking in. So the fundamentals that arose where I started investing in real estate, which made real estate a very good investment, drew me in. And then a bubble started forming, which increased the returns. And then as the bubble reached its top, it was painfully obvious to anybody from the outside looking in. You didn't have to be a financier, you didn't have to be a mathematician. You just had to understand simple math. 2 plus 2 doesn't equal 94. You don't have to know what 2 plus 2 equals, you just figure it's probably not 94. So my specialty was valuation, number one. Actually, my specialty was listening. And I'm good at catching people in lies because I simply listen. So they say one thing, and then 4 seconds later, they say something else. And I say, wait a minute, that doesn't match. You add that with simple valuation, simple addition and subtraction. Sometimes you get advanced with a multiplication division, and you're able to see a lot of things. So Bear Stearns didn't add up. With Bear Stearns, 2 plus 2 equaled 114, levered 5 times. We went over the balance sheet, my team of analysts and I, and it was a complete mess. You know, it was obvious it was going to collapse. And going through other banks, it was simply search and replace the name, but the same scenario. You know, balance sheet insolvency or liquidity insolvency. Bear Stearns, Lehman Brothers, Washington Mutual, Countrywide, etc. Bought a bunch of out of the money puts, which were underpriced because everybody was living in, you know, la la land. And once they were priced fundamentally or realistically, what you buy for 25 or 75 cents, we were able to sell for $80, $86. And sounds like crypto gains, right? And that was the story with Bear Stearns and Lehman Brothers, and keep filling in the blanks. That occurred. We were able to use that model multiple times because the cure to that problem was zero or negative real interest rates, liquidity pumps, QE, etc., which created more bubbles, which created more imbalances, which also made 2 plus 2 veer from 4 and go more towards 119. Short that, and then when reality hit, you were able to get profits. But something funny happened. Reality started going farther and farther away. Math started becoming less and less predictive. And now you have a scenario where price discovery is practically non-existent because you can't price risk, because risk is priced close to zero or even negative. That's when you have companies that are worth nothing and trading at ridiculous prices. And then you have companies that should have strong valuations, unpredictable prices. And that's where we are now. The consistent boom and bust, centralized economic management of central banks has totally destroyed true fundamental valuation in investment, in my opinion. And price discovery is a thing of the past. You have to find it in the museum, if you can't find it in the markets right now.
Yeah, I think that makes a lot of sense. And I know what you mean. It's like some of these investment banks, I don't know what brand calculator they're using, but they keep getting that 2 plus 2 question. They come up with a lot of answers other than 4, which we'll dig into today.
2 plus 2 equals commission.
I think that makes more sense than what I'm hearing out of some of these name brands. And Reggie, again, I appreciate you mentioning that because like you pointed out and like you have demonstrated, you're good at catching things that don't add up. Are you able to see the silver chart there relatively clearly on your phone?
Yeah, let me turn it. Yes, I can. I can zoom in. So, okay.
So we have this pattern here where right around 8 o'clock, the price falls off a cliff, then is almost dead flat, then spikes down and up, then down and up. We saw this again last night. I'm curious, any initial thoughts on a chart like that? Obviously, I'm giving you limited information, but does anything look unusual there?
Well, off the top of my head, it looks like 65% of silver mines were blown up in a terrorist attack. Demand then increased by 200% because the COVID lockdowns ended immediately and all manufacturing came back online. And then the silver mines that were left looked like they went offline again. So you had only about 10% of capacity. And all that happened within 24 to 48 hours. That would be my take. Or somebody's paying the prices. I'll let you decide which one of those two.
Well, Reggie, I appreciate that fantastic answer. By the way, Wall Street Reddit, there is one of the greatest memes I've ever heard. I'm going to play about a minute of this one because this was a fella analyzing Ethereum. And I'm wondering if what he pointed out here might be connected to what you just said. So give me one moment. I'm going to make sure I have the sound queued up, and here we go.
And what you're looking at there, do you remember when the crude oil went negative $40? Yeah, that's the same tail. That's the tail that I keep talking about that I love. So what happened here, Dick, is anybody that trades these cryptos on leverage, which means that they're basically trading on the exchanges or they're trading with stops, got destroyed this morning because it went down, and anybody that had a stop within 50% of where the market closed yesterday was probably knocked out of this market. And visualize it. Even if you got in here and you put a stop down in this range, 13, 14, you're gone. So you'd wake up this morning, your Ethereum is gone, your money is gone, and Ethereum is back up here. So this is...
So Reggie, based on... and were you able to hear him clearly there, hopefully?
I did, but he's a professional and I'm a neophyte because I'm not even aware of the Ethereum market closing and opening. But yeah, go ahead.
I'm curious, do you think that someone could have got stopped out on any of these sharp moves up and down? I know you're not seeing the trading records, but at least is that a reasonable possibility?
Well, it's quite possible they could have gotten stopped out, but it sounds like he is a traditional commodities trader. Um, like he says, when you go to bed, you wake up and your position is destroyed when the market's open. You know, markets, cryptographic markets don't open and close. They're 24 hours. They also, this is a big, for some reason, nobody seems to want to admit this, but there is no central pool of liquidity with crypto markets. And he acts as if it is. Cryptos are volatile simply because they're a nascent asset class. But when you try and or if you try and compare, say, Ethereum to oil, you're comparing Volkswagens and flying rutabagas with jet engines. There's simply no comparison. So with all due respect, it sounds like he has absolutely no idea what the hell he's talking about.
Okay. Well, although in terms of, aside from the particular asset, I guess I'm wondering at least that concept of getting stopped out, because I'm going to play about a minute. This is former Commissioner Bart Chilton, who presided over the CFTC's investigation into silver. And I asked him what my understanding was, and you can hear what he said here, and we'll get your comment. Again, I appreciate you mentioning the spoofing. Curious, because my understanding of how some of the manipulation has occurred is that, if silver is trading $20.05, there's a lot of stop orders placed around the $20 handle. So often if the price can get pushed a little bit, then you get a lot of those high frequency algorithms kicking in, and then you'll see a drop, with many feeling that people kind of nudging a little are then able to buy lower. Does that sound like a reasonably accurate portrayal to put it in perspective to folks, or would you phrase it differently?
Well, it's a good portrayal, but it's a very good portrayal.
And then he goes on to describe the mechanics of spoofing for 3 minutes before finishing with
seconds. So the difference in your description is that today, when a market moves because of a spoof, it can move a lot more.
So Reggie, going back to those charts we looked at, here's March 1st. You see price decline where there's volume. Here's March 3rd. This is today, where volume just picks up. I guess a lot of people wanted to sell. I don't know of any fundamental reason. Here is the volume on the chart of today. So again, you have imperfect information, but which do you think is more likely, that the banks did exactly what Commissioner Chilton cited, or that the supply and demand profile changed quite drastically over that 24-hour period?
Well, it's obvious that there's the volatility is unhinged from the fundamentals of the physical metal. That's a polite way of saying someone is playing paper games. The fact that the paper has become a bigger market than the actual physical is why you have to speculate on this. If you were trading the actual physical, or at least paper that was one-to-one hinged to the physical without leverage, then you would know exactly what was going on, because it's very, very difficult to move physical metal at that level of volatility. And if you did, then it would even itself out automatically. I'm not a disbeliever of leverage. I'm a big believer of leverage, but you have to lever outside of the system, not inside of the system. If you lever outside of the system and you take a loss, the people who lent you the money simply don't get paid back. Okay, you don't have price games. You have losses to those who facilitated the risk. When those who facilitate the risk take the loss, then they charge much more money for that risk next time around. And that's how a real market works. Okay, you have equilibrium because risk has a real price to it. When you drop rates close to zero, you give up money for free, and then you can move prices irrespective of what the fundamental, the underlying value of commodity is. Then you come up with charts like that. There is no way in the world, look at any physical asset or commodity that is traded and has any sort of liquidity, And it is impossible to see prices move like that. Simply impossible. Because there's, nobody benefits from that unless you are a momentum trader, and the momentum traders simply can't move thousands of tons of silver that quickly.
Yeah, there's only one group I know of that seems to be able to pull the trick off, although we will leave them nameless for today. Yet, with all of that said, for people some of whom are new to silver because they heard about a silver squeeze that the banks say, hey, that's just a Twitter hashtag. I've been talking to dealers and people around the world that report a different story. I'm curious, based on what you've seen in the last month, and where do we stand today, and what would you say to folks who are not sure what to think?
Well, if we were to do a deal, okay, I would offer to give you $100,000 in US dollars, okay, confirmed US dollars cash, or write on a piece of paper, I will give you $100,000. You can trust me. Which would you choose?
Well, I'd ask for silver myself, but I guess at least the cash, if I'd ask for some a Veritaseum receipt over either of those personally.
So one thing, I think the last thing you asked for is that little piece of loose leaf paper that says, I will give you. Okay. And that in itself is the crux of the problem. I think the infrastructure of Wall Street exchanges and ETFs, et cetera, have created a problem by bastardizing actual assets and commodities that the regulators simply do not want to face. One reason is because it provides large amounts of money to the financial industry, particularly Wall Street. But number two, it is almost impossible to fix this problem without breaking something very significant, and that is the balance sheet and the creditworthiness of the participants, which are the Wall Street banks. The problem is this doesn't go away. It's going to get worse. And the reason it's going to get worse is because the incentive to do it is profits. Profits for the entities, bonuses for those who work for the entities. And Wall Street has never done a halfway decent job of self-policing. Whenever they had the opportunity to self-police, they didn't. And they created a bomb, and the bomb blew up. You go back to the Bankers Trust days. Bankers Trust no longer exists. You go back to the Bear Stearns days, the Lehman Brothers days. Hey, those banks don't exist. This didn't happen back in the 60s and 70s because the banks or the banking institutions didn't have access to fake money and excessive leverage. Or if they did, they didn't want to take the risk because they were partnerships. So the first one to take a loss was the actual partners of the bank. So they were much more conservative. Then someone came up with an idea. Instead of selling stocks to companies for others, why don't we sell our own stock, right? Make all the shareholders take the risk, lever up, and we just keep all the profits. So when you switch from the partnership model to the public company model, all the risk shifted over to the shareholders. And for some reason, banking shareholders don't believe in the bank itself sharing the risk. If I own a large amount of bank stock, the first, second, or third tranches of risk will be taken by the employees and by the manager. And then I take everything left over. If that would be the case, guess who would never blow up? The bank. But since that's not the way it works, that's why we have all these shenanigans. And on top of it, once they get caught, the repercussions for bulge bracket brand are significantly less than repercussions for somebody like, a crypto startup or ICO.
Yeah. Well, I'm glad you mentioned that. I have a scenario. I mean, I sit here thinking about silver all day, which I'm not. Kids at home, don't do this. Not advice. Choose a different career. Be a lawyer or something. But I'm curious if you could give me a moment to lay out a scenario and then tell me if this makes sense or if there's something else. I got David Morgan. He couldn't come up with an answer to this one yet. So it seems to me that, if we're this late in the game and now Janet Yellen's talking about going big, I can't think of any way that the debt gets repaid or the Fed's balance sheet can ever, it's to me mathematically impossible. Would you agree with that part?
It may be, but understand personal finance and sovereign finance are very different. So I can't think of any country that has paid its debt completely and has prospered. So their goal is not to pay the debt back. you know. And if you have the biggest guns in the world, you don't have to pay the debt back. You just have to take somebody capital, and then you start the game from scratch. But with that being said, I think they're really pushing their luck, and they're playing. This is close to the end of the dollar hegemony as a global reserve currency. So a long-winded way of saying, yeah, I agree with you.
Yeah, well, everything you said makes sense there. And, you know, there's this idea, especially in the precious metals community, well, if we see $50 or $100 silver, that's not a world that you're going to want to live in. And I get the sentiment behind that. Although it hit me the other day, and you just mentioned it again, where the banks are set up so that the banks stay in business and they screw the customers when needed. And if the COMEX contracts are legally worded that you can settle to cash, and that's not even technically a failure, it's in the contract that you can settle to cash. I guess I was thinking that, I mean, I don't know, maybe these bankers just still can't see that this is coming to the end, but you would think someone would be able to grasp that. And my question is, couldn't we actually have a scenario where if they're going to just settle those contracts to cash, they could really reset gold and silver to any level they wanted, and you wouldn't have banks defaulting because, I mean, maybe they'd pay out the open loss on where it's marked now. But I mean, like, if the shorts don't have to pay out on those, I mean, you could do a 8-to-1 ratio. You can make gold $200,000 an ounce, silver $25,000 an ounce. In fact, there would actually be an incentive. The higher they make the number, the more debt they could wipe out. And it's essentially, you know, we had Bretton Woods, and then when that unraveled in the London gold pool, they cooked up the COMEX. So it was just an extension of the same rigged system. And as you astutely point out, I'm sure they're at least going to try to come up with the next system. But any thoughts on the specific part of the mechanics that if you have those contracts settled to cash, you could actually set gold and silver at any level you want? Most of the planet would have no idea.
Right. And part of the problem is, you know, people don't read perspectivism, and they do. I think that they don't do their own fundamental research and homework. I think they simply listen to someone else that says, buy this, buy that. Here's a good example. I just came up with a good example. I'm sitting on the corner of my block, so don't look at the street signs, you can figure out where I live. That is grass. That's wild grass. Okay? I don't know how much they paid for it, but I don't think they paid an awful lot for it. But it has a value. So let's say we have a silver contract, okay? SLV silver contract or a futures contract. And normally that contract is supposed to settle in the hard metal itself. Okay. Instead, right, it's rewritten and it settles to grass. But grass has a value. Let's suppose grass is not worth a whole lot. 1 ton of grass equals $1,000. Okay. But it still has a value. But if you settle silver to grass, right, and then the US dollar and the grass price plummets, people exercise their silver contract, they get grass. But what value would grass be if silver is flying up in price and you want to settle and get silver? So now you buy 100,000 kilograms of silver, okay, contracts, you settle, and instead of getting silver, you get 4,000 tons of grass. Worthless. The grass is the same thing, it's the same color as the US dollar, and it'll be about the same value as well, right, as inflation takes off. So not only do people not truly read the contracts or their futures or ETF contracts for their benefit, you know, they don't read it objectively, but I don't think a lot of people or investors, maybe institutions, understand the ramifications of even buying silver. Silver is FX reserve, in my opinion, and it's a fail-safe when things really go awry. So is gold, and so is a lot of potential FX reserve replacements, such as certain cryptos. But that's a complex story, so we'll go over that later. So when things go awry, okay, usually they go awry because inflation gets out of control at the same time that economic activity doesn't match it. And that's when you're in trouble. And that's when you want something to replace a soft dollar. Grass isn't going to do it. The dollar isn't going to do it. Now, I also listen to the central bankers, and they say, well, we have inflation under control, right? We don't see rampant inflation. That is nonsense. You know, I don't know where you live, but I'm in New York. If you order seamless from the Chinese food store on the corner, okay, not, you know, the Mandarin Palace on Madison Avenue, 5-star restaurant, the Chinese food store on the corner with the little white boxes, $40 for 2 people. Okay. A year and a half ago, that same meal would have been about $29, literally. That is inflation, not just inflation in the actual food components, such as soybean oil, et cetera, but inflation in the cost of the services and the actual price to the end user. And it's significant inflation. It's not up 1% or 2%, it's up significantly. You go to the supermarket, you see big differences. And then let's ask the people in Texas if they've noticed inflation in their utility bills.
Actually, Reggie, I don't know if you know, I'm in Austin right now, and I was here for that false flag where, you know, they had half the town lit up. Well, shocking to me that the reports were that people actually died. And when I saw some things that I wouldn't want to have to answer in front of a congressional investigation, it was quite shocking.
Right. But to say that it doesn't exist, you know, and, you know, when you smooth inflation out like the Federal Reserve does, you can say that there's no rampant inflation, core inflation. But the problem is every time you smooth it out, you take out the things that people need. So as long as you don't need a house or heat for that house or feed yourself or your children, then inflation is pretty good. But the second you get hungry, cold, or need someplace to stay, then you see inflation is already taken off. That's before the $2 trillion third stimulus package from just the fiscal side. And the monetary side is out of control. You know, they stopped printing the M2 numbers, but you don't have to have the M2 numbers. Just look at the monetary base. This is a key for everybody else. You go to Fred, the St. Louis Federal Reserve site, and just look at the monetary base and look at the difference in increases. So all this combined means that if you're going to use silver as an actual investment or fail safe, you want to be able to get silver. If you can't get silver, you need something that can replace the risk of hyperinflation. Not hyperinflation, of rampant inflation. Okay, that wouldn't be grass, that wouldn't be US dollars, that would be something hard, tangible, and difficult to replicate, like the gold, the silver, etc. So again, I'm talking of a long-winded way of saying, you know, settling to cash defeats the purpose of buying silver in the first place. Why didn't you just buy cash?
Yeah, well, it's kind of funny. It makes me chuckle wondering what they have at Goldman Sachs if you pay for your, like, get a futures contract on your lunch while they hedge it on the COMEX. By the way, about inflation, it's confusing to me because I know Jerome Powell was in front of Congress last week talking about how he's ready. And Reggie, tell the grass over there, if you can, that in case inflation's a little bit too low, he's ready to overshoot, pick up for the inflation deficit. Yet somehow at the same time, 10% GDP growth, the U.S. economy is on fire and is about to get stoked even more. Although, Reggie, I'm guessing you had more important things to do yesterday than listen to Jamie Dimon's interview where the guy asked him if, you know, there's a chance things could overheat. And he's like, well, maybe, although I'm far more concerned about COVID and nuclear war. Although Jamie Dimon oddly did mention that he wouldn't buy 10-year treasuries, which seemed odd statement for the head of the JP Morgan to say. Yet when you unwrap all of that, I mean, curious with what you've seen in silver, and you just explained these contracts that I wouldn't touch. We saw the SLV midnight prospectus changes that Jeff Curry forgot to mention on any of his Bloomberg or CNBC appearances. Is there some way that this is not heading towards a pop? Jeff Curry of Goldman Sachs says there's no chance of a short squeeze, yet they stick language in the prospectus guarding against a short squeeze. What are the possible ways this can play out?
Well, if I'm not mistaken, the prospectus actually mentioned a Reddit discussion group. What is that doing in the prospectus? You know, and a conspiracy of people. That is not what goes in the prospectus. That alone should tell you there's really something amiss and awry. And as for the 10% GDP growth pop and catch on fire, you know, open up another tab and do a search on unemployment rates. Yes, they've improved slightly, but if you take a look at the unemployment insurance claims, it is still just about a world's record, going back to before they started, going back to the first year claims. So how do you have a 10% pop and the economy catching on fire when you still have a record number of people filing for unemployment? So it must be all AI and bots generating that revenue, or all banks.
See,
Because
Reggie, you want to know the answer to that? How it can happen?
Tell me.
You got to be a Goldman or JP Morgan client. It's secret sauce.
You know, what it sounds like to me, if the economy is even slightly heating up, it sounds like you have stagnated inflation.
Yeah.
Okay. Stagflation is a short term for that, where you do have inflation and then you have a stagnating economy at the same time.
Yeah, well, I'm sure the Fed will be explaining how that works anytime. Although, another question for you, Reggie. You mentioned on your great interview last week with Jean-Claude of Beyond Mystic, you mentioned about the cost of production. Part of what got me into silver, and in fact, my partner who helped keep this Arcadia thing going, she was intrigued when I was mentioning how silver, the COMEX price, at one point was below what it cost many of the miners to get it out of the ground. I didn't hear JP Morgan mention that in any of their reports, yet you mentioned there was a JP Morgan report where they said Bitcoin was overvalued because it was too high over the cost of production. So I'm confused. Please, I'm so grateful you're here, and maybe you can explain it to me.
I have no idea what the hell he was talking about, to be truthful. The cost of production, what I did was I wrote a long blog post at boombuzzblog.com. That's my opinion and analysis site. That's where we launched the Bear Stearns relief and analysis, etc. And I tried to get to the root of why Wall Street and regulators and politicians really, really just don't get crypto. And the reason is because they act like it's a stock. So let's forget what JP Morgan said was that Bitcoin is overpriced because it's too far above its cost of production. Okay, so before we address that, let's take a look at what Bitcoin is. Bitcoin is a protocol-based platform, and it's a paradigm shift. It's basically a big change in the way the world works. The last big paradigm shift we had was a big one, probably the biggest. That was the internet, circa 1992, 3, 4, 5, depending on who you're asking. Okay, but that one wasn't regulated, so you didn't have regulators, saying that this particular startup was a fraud or it broke securities laws. They just let it run, and that's why the United States is the leader in internet technology. And the value, right? Each protocol, both Bitcoin protocol or any decentralized ledger protocol and the internet protocol, both work off of packets. With the internet, it's IP or internet protocol packet. With Bitcoin, it's the Bitcoin protocol, and then you just use any other blockchain like Ethereum, et cetera, et cetera. You have little accounts of values that go back and forth, and that's how the system keeps an accounting of what's going on. With Bitcoin, right, the Bitcoin account of value was called a currency, a digital currency. That might have been a mistake because now people automatically assume it's a financial platform, it's Wall Street driven, et cetera. It is not. It's basically information, okay, that is moved back and forth in a database that has an immutable way of recording transactions, and it uses consensus to do it. So if the majority of the computers and the people on the network or the participants on the network agree that the transaction has occurred, then that transaction occurred. It goes into the database and it's locked. The internet protocol is very similar, but let's suppose that we had the world treat the internet and the internet protocol as they treated the Bitcoin protocol. That means that people will be hoarding internet packets like they're hoarding Bitcoin, okay, hoping that they get rich because the price of these internet packets will go up. So let's suppose that was a potential, it was possible. Would you be wealthier hoarding a whole bunch of internet packets, or would you be wealthier building a macro or application on top of the internet? And I'll give you examples of these applications: Google, Amazon, Facebook. Okay, so just fast forward 30 years and you see how asinine it is to even think about, hoarding internet packets versus trying to actually build upon the platform. Now, we leave the internet and we go off to Bitcoin and other platforms, and we have these banks trying to accrue the value to individual packets versus the actual platform itself. Okay, it's almost impossible to value an internet packet because the value of the internet itself, or internet protocol, the IP, total account value, it's almost impossible to value that because now you see how massive and overwhelming the value of the internet is. If you were to value the internet, it would be almost impossible because it's ingrained in almost everybody's lives, not everybody, but almost, and it runs practically every business system. You know, we're having this conversation through the internet, video through the internet, sending information through the internet. Someone could buy something through the internet, et cetera, et cetera, et cetera. Okay, the distributed ledger system, whether it's going to be Ethereum, Bitcoin, a mash of all blockchains or something else, the value is going to be in the system itself. So to hear a banker say that the system is overpriced because the little Bitcoin or internet packet is overpriced because it is trading at a value above its cost of production shows he has absolutely no idea what's going on. He's ignoring the system. He's ignoring the network effect. He's ignoring the adoption. He's ignoring how deeply ingrained it is in the world, economy, and society, personal life, etc. And he is taking a close look and he sees just a bunch of gray. And just 2 steps back shows a tree. You know, 4 steps back shows a neighborhood. 10 steps back shows the forest that used to be New York State.
Yeah.
So,
well,
JP Morgan, you know, need to go to school. I'll gladly teach you. Pay some tuition.
well, we'll leave them aside. One last one for you before, hopefully when we wrap up, you can touch on how Veritaseum connects with the silver and especially can be a solution against some of these things that have been going on. But any thoughts on what actually happened when the Fed was shut down last week?
They got hacked. I mean, they said it was a operational error. An operational error that shut down each and every facet of the most powerful, largest, and deepest central bank in the world. So basically, you know, a secretary was walking into tripped and pulled the plug out. The whole government went down. That's sarcastic. So I looked it up, and the Federal Reserve got hacked over 50 times in just 4 years. Just last year, right before the end of the year, they took out, they hacked the Fed significantly. So that is a real-time example of why distributed ledgers work, because it would be very, very difficult to hack that many properties on a distributed or even decentralized ledger. Very, very difficult because the attack vector would be much smaller, the attack surface would be much smaller, and you have so many more things to attack. I didn't realize the Fed was hacked so often, but the Fed is looking into centralized central bank digital currency. But the problem is you have a circular argument. You have a conflict because in order for the central bank to be a central bank, they have to be what? Central, right? In order to get the full effect of a distributed or decentralized ledger, you have to be decentralized and distributed. So their best bet is they'd have to do a hybrid solution. But once they do that, that central portion is going to be a honeypot. Okay, and you're going to have a lot of people going after it, and not just people, 14-year-olds in their mommy's basement, but you're talking state actors with large amount of resources. And it's not just the Federal Reserve; it's the the People's Bank of China, Republic Bank of China, Bank of England, ECB, etc. Luckily, we have a partial solution to that. We have a patent granted, and I consider myself the originator and inventor of DeFi back in 2013. So we were just granted a patent, enforceable in about 39 countries thus far, and we're still building on that. And I'm going to focus on using central bank digital currencies for peer-to-peer transactions. Basically, the cross-currency swaps that the central bank, the Federal Reserve uses to give dollar liquidity to the ECB during times of disconnect in the Bank of England, the Bank of China, etc. This could be done peer-to-peer through the blockchain, and very, very difficult to hack. Unfortunately, because of litigation issues, it's not going to be allowed in the United States. So I think it's quite possible that we have a savior that will save everybody except for the United States because of regulatory issues that forbid it to be used in the United States. But I don't want to go into that.
Well, I'll give a hands up to Uncle Sam for driving our finest entrepreneurs abroad and making good products illegal here at home. I'm sure that they will be bragging about that in the next election. Also, it is kind of amusing that the Fed's security policy might actually even be worse than their monetary policy. And it's amazing that like the best chance we have for free market. I don't know what to think about what happened last week, but I'm like, well, at least the short squeeze is where these guys got screwed by Robinhood shutting them down the week before. I mean, I don't know whether I'm supposed to hope someone hacks the Fed and that's like a chance at free markets is our best hope. Although actually we do have one hope better. Reggie, I know there's a lot of people that when these things blow up, and they say, how come nobody said anything? How come nobody stood up and did the right thing? You are one of those people, and I admire that. You've been a role model to me, whether you knew it or not over these last couple of years. And you're finding solutions. You're not even when some regulators did something that I personally find disgusting, but we'll leave aside for now. You didn't complain. You got back up there and continued doing what was important in the world. So before we wrap up, take as much time as you need, but can you just tell folks about what you're doing, how that helps address some of these things? Also, how people can help support what you're doing, because I feel it's pretty darn important. And lastly, if you can keep in mind that we are silverbugs, not crypto experts, and you can dumb it down for us a little bit.
Okay.
And I'll pull up your website while you do that.
Okay. Well, ever since 2013, I've been delving into crypto. And as I tried to explain earlier, my view on crypto is very different from everybody else's. It's not about tokens and coins, speculation on individual prices of Bitcoin and Ethereum. It's about building a new method of value transfer. Just like the internet is a new method of information transfer, and it works very, very well. Theoretically democratize information. The technology behind the blockchain will do the same, and it will do the same regardless of whether it's regulated or not. They're not regulating the technology, they're regulating implementation of technology. And I think they're doing so, at least the US is doing so in a very, very self-destructive manner. Like you said, they're chasing both intellectual capital and intellectual property offshore. There's a reason for it, but I don't want to get into it. But, long story short, without getting deep into it, I believe it's protection of status quo. And that's like wanting to protect print newspapers as the internet takes over. It's a wasted effort, and the print newspapers were going downhill anyway, just like vinyl records and MP4, MP3s, etc. But you have a concerted effort to keep this in play. So I'll give 2 examples or 3 examples of what we've done. What you see here is tokenized precious metals, where I take precious metals and I sell them. The company that runs that particular site is a precious metals dealer, and you simply go and buy gold, silver, or palladium. You could simply buy it, take possession of it by having it shipped to your address and go home, or you can buy it and put it in a storage. And then where normally you get a paper receipt, you're getting a cryptographic receipt. That little token account of value that I explained, like the IP packet, this, or like a Bitcoin, this is account of value that proves that you purchased 5,000 ounces of silver, 30 ounces of gold, etc., down to small fractions of a gram. Okay. Now that small cryptographic receipt represents or is proof that you own XYZ precious metal in a vault that is insured by Lloyd's and secured by Brinks. And whenever you're ready, you simply send it back to the site by hitting a redeem button. You pay for shipping, and they ship the metals over to you. Very simple, basically. It's just old school metal and metal sales and storage using a new technology paradigm. We filed an application, patent application for peer-to-peer value transfer early in 2014. And basically what it does is it explains how to create devices, methods, and systems to allow two total strangers to do business with each other by transacting value without knowing each other and without counterparty risk or credit risk. So you know you will get paid according to the contract that you agreed to. That was just granted in a foreign country in October. And that country, unlike the US, is very open to trade agreements. And so through that country, this is enforceable in 39 different countries around the world. All of the EU, all of North America, except for the US and certain parts of Asia. And we're working on several other grants as well. With this, we're bringing all this technology that we built up to speed using the current tools that are available, because a lot has changed since 2014. And we're allowing peer-to-peer capital markets. So now, instead of going through an exchange for anything, you can deal directly with each other. Instead of going through a broker, you can deal directly with each other. Instead of going through a bank, you can deal directly with each other. I could go through the simple business model. You know, a bank is an aggregator of capital, period. That's all they do. They connect savers and they connect savers and investors with borrowers and spenders. So by connecting them, they allow capital to move and they charge you a middleman fee. You take the middleman out and have this done through the blockchain, and you get to keep your fees. And a software contract called a smart contract does all the functions that the bank used to do. And you're not exposed to any counterparty risk. So you can never have a Bear Stearns collapse, the Lehman Brothers, et cetera. That's a very, very important invention. Risk of a deal not going through is the primary cost of doing business and having a transaction in anything, whether it's finance or investment, a regular business transaction, a transaction between friends, neighbors, etc. So what we feel we've invented was a new way of doing business. Suppose you want to buy silver or sell your silver, but you want to sell your silver to a total stranger in Hong Kong. You can do that using our contract. You don't have to know that person. You don't have to know what that person's credit risk is, balance sheet, etc. They put the capital up into the blockchain. You put your silver up in the blockchain. It's verified. The transaction is done. Everybody can walk away. It's impossible to renege on it. And there are other permutations of the invention as well, where you can use, mediators and valuation agents, etc. But that's beyond the scope of this particular conversation. So this is very, very exciting. As a matter of fact, tokenized silver plus peer-to-peer capital markets means you can literally bring silver back to currency if you wish. You can have digital silver currency, digital gold currency, and you can transact with it, and it comes with its own rails. So you don't need anything. You don't need PayPal. You don't need Citibank. It's a very, very exciting world. But like I said, it's mired in risk because of regulatory scrutiny. But there are countries that are a bit more open-minded. And I think that those countries are definitely going to benefit. The cross-currency swap product, once we get that polished off and going, I think will work wonders for balancing weak currencies around the world, which I think silver will play a part in. The reason why silver doesn't make it good currency is because of volatility. And as you see in those charts and the admittance of certain large players, a lot of that volatility is synthetic, comes from manipulation.
Yeah, that certainly is the case. And Reggie, I guess one add-on question there, because this is how I've been thinking of it, and perhaps you can tell me if that's correct or not. But we discussed the issues with the COMEX and how they could settle. So if that thing exposes itself as a complete fraud, one of the questions I get a lot is that what do we go to next? What do we do if the COMEX can't be counted on, which is already the case? But is what you're building here essentially something that can facilitate that without the fractional reserve nature?
The COMEX is a giant middleman, a reserve designed to mitigate risk of counterparty failure. You don't need it anymore. You don't need a COMEX. You want to buy silver, right? You go to somebody who has silver to sell. You do it through our zero trust platform, and you don't have to trust them. You simply do it. So think of the COMEX as the center spoke of a old-fashioned bicycle wheel, okay? And then you have a bunch of spokes. At the end of each spoke is a broker or another exchange, a bunch of brokers. That's not necessary when you could go from one end of the spoke to another end of a different spoke directly and sidestep the center hub. So centralization in this particular scenario is not only not necessary, but it actually adds risk to the equation because you're adding a third party, and that third party exposes to additional counterparty risk. Normally, if I dealt with you directly, there's two sources of counterparty risk. There's me and you. If I dealt with you through a third person named Jack, now I have me, you, and Jack. Now, if I could find a way to both eliminate Jack, so we take 33% of the counterparty risk away, and then eliminate each other as counterparties by having us interface with the blockchain, which is an immutable database, then the blockchain is now everybody's counterparty, and the blockchain doesn't favor anybody mathematically. It has yet to be hacked successfully. So it makes practically and essentially a counterparty risk-free counterparty. So this is the best of all worlds. You know, just like if you're on the internet and you wanted to send 600,000 page document, okay, you can send it via email, right, or FTP, or you could print it out. You can hire a courier, send that courier over to Austin from New York, and have them drop it off, and then you have it, which is more efficient, which has more risk, which has more cost, which is faster, which is more reliable. You know, there's absolutely no comparison.
Yeah, well, I think when we're talking about the COMEX, certainly that's something people can associate with. And Reggie, by the way, I was writing down a note here because when you said COMEX, we don't need you anymore, that is now going to be made into a new T-shirt that we will stock in the Arcadia store. And I'm going to send you the complimentary first print. Hopefully you'll let us use the licensing rights for that. Great. Dear COMEX, we don't need you anymore. So Reggie, I sure appreciate what you're doing. Although before we let you run, can you let people know, obviously it's complex what you're doing. What's the best way that people can get more information so that they can feel comfortable understanding? And then B, if people do want to support what you're doing, how is the best way for people to help?
Well, the best way to, you can reach me at Twitter. I'm pretty prolific on Twitter. That's at Reggie Middleton. You can't really reach me on Twitter, but you can see my tweets. I don't really respond to a lot of messages on Twitter. To interact with the community, it's a small community, but it is very knowledgeable and very active. Reach out on Telegram. That's Veritaseum official at Telegram. So if you do I think if you do a Google search for Veritaseum official Telegram, you'll get the link. And I think you have the link, but if you don't, you should be able to find it in the Google search. Also, you can see how active the community is because the community is looking to defend its rights against what they consider, not necessarily me. I have opinions, but I'm not going to give them. What they consider is overzealousness on the part of regulators. When you go to the Veritaseum official link, you can ask them for the Veritaseum token holders versus XYZ regulator. They'll fill you in. They'll give you a link to the chat, and I think you will find it enlightening. The vast majority of the Veritaseum community are also strong believers on hard precious metal. I guess it's a similar crowd. And you could go to the actual dApp to see what's happening. A lot of the metals have been cleaned out. We got cleaned out of silver. We'll be replacing it soon, hopefully. But, there've been some issues there. But the next rollout of the technology is going to be an actual intellectual property rollout, IP, and then new code as well. And it will be absolutely amazing. I can guarantee you. And we would have the opportunity to defend ourselves. So this David Goliath fight, David now has, some hard artillery to protect himself with.
Well, Reggie, I sure appreciate that. We'll get all those links in the description field below so people can stay posted. And if they would like to get involved or just understand and find out more about what you're doing, hopefully the buzz phrase that the COMEX, we don't need you anymore. And Reggie is doing what he can to provide a replacement for that. So Certainly something that's well needed. And thank you so much for making some time today. And I know you're outside there, but we'll let you get back to it. And please keep me posted. Anything that I can do to help your efforts going forward.
Okay, and anybody at the COMEX who disagrees with my perspective or thinks otherwise, gladly debate you, okay, politely, professionally, and in public. I would welcome it. I think it's an experience for all of us, myself included. Okay?
Yeah, and I think a great way to end it, as we know there are other banks that say stuff and then never stand behind it. So perfect way to end it. Thanks so much, Reggie, and we'll look forward to checking back in with you again soon.
Okay, thank you. Thank you for the opportunity.
All right, and we are clear.